The Roth IRA conversion strategy that saves $94,000 in taxes. You've been contributing to a traditional IRA or 401k for years, getting tax deductions now. But when you retire and start withdrawing that money, every dollar is taxed as ordinary income. What if I told you there's a strategy to convert that traditional IRA to a Roth IRA strategically over time, paying taxes now at lower rates so that all future growth and withdrawals are completely tax-free? Done correctly, Roth conversions can save you $50,000 to $200,000 in lifetime taxes. I'm about to show you exactly when to convert, how much to convert each year, and the massive tax savings this creates. What a Roth conversion actually is. A Roth conversion is moving money from a traditional IRA or 401k into a Roth IRA. You pay income tax on the converted amount in the year you convert, but then all future growth is tax-free. All future withdrawals are tax-free. No required minimum distributions at age 73. You can leave it to heirs tax-free. The key is doing conversions strategically during low-income years when your tax rate is lower than it will be in retirement. Why Roth conversions save massive taxes. Here's the basic math. You have $500,000 in a traditional IRA at age 50. You're currently in the 24% tax bracket, but expect to be in the 32% bracket in retirement due to RMDs, Social Security, and pension income. Option 1. Leave it in traditional IRA. Age 73 plus, required to take RMDs. Each year you withdraw $40,000 taxed at 32%, equals $12,800 in taxes. Over 20 years of retirement, $256,000 in taxes paid. Option 2. Convert strategically over 10 years. Convert $50,000 per year from age 50 to 60. Pay taxes at 22% to 24% bracket equals $11,000 to $12,000 per year in taxes. Total taxes paid on conversions, $115,000 to $120,000. After age 60, all withdrawals are tax-free. Total taxes paid over retirement, $120,000. Savings, $136,000 in lifetime taxes by converting strategically and paying taxes now at lower rates. The perfect time to do Roth conversions. Roth conversions work best during specific life situations when your income temporarily drops. Early retirement, age 55 to 65 before Social Security. You retire but haven't started Social Security or RMDs yet. Your income is low. Convert large amounts in the 12% or 22% brackets. Gap year or career transition. You take a year off between jobs. Income drops to zero or near zero. Convert as much as possible while staying in low brackets. Business loss year. Your business has a down year with low or negative income. Offset conversions against the loss. After large deductions, you have major medical expenses, charitable donations, or business losses that create big deductions. Convert to fill up those lower brackets. First few years of retirement. Before RMDs kick in at 73, you have a window to convert at lower rates. The worst time to convert is during peak earning years when you're already in the 32% or 37% brackets. You'd pay high taxes now and potentially lower taxes later. How much to convert each year? The goal is to convert as much as possible without bumping yourself into a higher tax bracket than you'd pay in retirement. Step 1. Determine your current tax bracket. If you're in the 22% bracket, your taxable income is $94,300 to $201,050, married filing jointly, 2025. Step 2. Calculate room to the top of your bracket. If your taxable income is $150,000, You have $51,050 of room left in the 22% bracket before hitting 24%. Step 3. Convert up to the top of your bracket. Convert $51,050 this year. Pay 22% tax, $11,231, and stay in the 22% bracket. Step 4. Repeat annually. Next year, reassess your income and convert again up to the bracket threshold. This fill-the-bracket strategy maximizes conversions while minimizing tax rates. Real client example, $94,000 tax savings. I worked with a couple, David and Linda, both aged 58. David retired early with a $600,000 traditional IRA. Linda still worked, making $80,000 annually. Their plan: convert David's IRA to Roth over 7 years before Linda retired and before RMD started. Their strategy: year 1 to 5, convert $60,000 per year while Linda still works. Pay taxes at 22% bracket equals $13,200 per year. Total converted, $300,000. Taxes paid, $66,000. Year 6-7, Linda retires. Convert $100,000 per year at lower brackets. Pay taxes at 12% to 22% blended equals $18,000 per year. Total converted, $200,000. Taxes paid, $36,000. Total, $500,000 converted, $102,000 paid in taxes. Alternative scenario if they hadn't converted. Age 73, RMDs force large withdrawals. Projected retirement income puts them in 32% bracket. $500,000 withdrawn over retirement at 32% equals $160,000 in taxes. Plus, the $500,000 grows to approximately $900,000 by age 75, assuming 6% growth over 17 years. All that growth would be taxable without the conversions. With conversions, $900,000 of tax-free Roth money. Without conversions, $900,000 taxed at 32% equals $288,000 in taxes. Total tax savings, $186,000 by doing strategic Roth conversions over 7 years. The 5-year rule you must know. After a Roth conversion, you must wait 5 years before you can withdraw the converted amount penalty-free if you're under age 59 and a half. This means if you convert $50,000 at age 56, you can't touch that $50,000 until age 61 without paying a 10% penalty. However, the 5-year rule doesn't apply if you're over 59 and a half. Withdrawals are always penalty-free after that age. You're using the money for qualified exceptions, first home purchase up to $10,000, disability, certain medical expenses. Each conversion has its own 5-year clock. If you convert in 2024, 2025, and 2026, each has a separate 5-year waiting period. This is why Roth conversions work best in your 50s or early 60s. You're close to 59 and a half, so the 5-year rule is less restrictive. How to execute a Roth conversion. Step 1. Determine how much to convert. Calculate your current taxable income and identify room in your tax bracket. Decide if you want to convert up to the top of your current bracket or a specific dollar amount. Step 2. Contact your IRA custodian. Call Vanguard, Fidelity, Schwab, or whoever holds your traditional IRA. Say, I want to do a Roth conversion of amount. Step 3. Complete the conversion paperwork. This is usually a simple online form or phone call. The custodian moves money from your traditional IRA to your Roth IRA. Step 4. Pay the taxes. The conversion is reported as income on your tax return for that year. The IRA custodian does not withhold taxes unless you request it. You can either Have taxes withheld from the conversion. Not recommended. You lose money to taxes that could grow. Pay estimated quarterly taxes to cover the conversion. Pay when you file your tax return. Make sure you have cash set aside. Step 5. Track the conversion for the 5-year rule. Document the conversion date and amount. If you're under 59.5, mark the date 5 years later when penalty-free withdrawals begin. The entire process takes 15 to 30 minutes and can be done multiple times per year if desired. Common Roth conversion mistakes. Mistake 1. Converting too much in 1 year. Converting a massive amount in 1 year bumps you into higher brackets. Spread conversions over multiple years to stay in lower brackets. Mistake 2. Not having cash to pay the taxes. Never use money from the conversion itself to pay taxes. That defeats the purpose. Have cash in a separate account to pay the tax bill. Mistake 3. Converting in high-income years. If you're in the 35% bracket now and will be in the 24% bracket in retirement, conversions make no sense. Wait for lower income years. Mistake 4. Forgetting about Medicare IRMAA. Roth conversions increase your income, which can trigger higher Medicare Part B premiums if you're over 63. Plan conversions before Medicare or after you're already in higher IRMAA brackets. Mistake 5. Converting after age 73. Once RMDs start, you must take your RMD first before you can convert additional amounts. This limits conversion opportunities. The Mega Backdoor Roth Strategy. If you're still working and your 401k allows after-tax contributions, you can do massive Roth conversions. Some 401k plans allow you to contribute up to $69,000 per year. $76,500 if 50 plus, through a combination of employee deferrals, $23,000, employer match, variable, after-tax contributions, whatever's left to reach $69,000. If your employer allows in-plan Roth conversions, you can convert those after-tax contributions to Roth immediately, creating a massive Roth balance. This is advanced and only works if your plan allows it, but it's legal and can funnel $40,000 to $50,000 per year into Roth accounts. What to do this week? Pull your most recent tax return and identify your current tax bracket. If you're in the 22% or 24% bracket, conversions likely make sense. Calculate your taxable income and determine how much room you have to the top of your bracket. If you're in a low-income year, retired early, between jobs, business down year, calculate how much you can convert without exceeding the 24% bracket. Contact your IRA custodian and ask about their Roth conversion process. Some can execute conversions same day. Consult with a CPA or tax professional to model your specific situation. They can run projections showing long-term tax savings. If it makes sense, execute your first Roth conversion this year. Start small. You can always convert more next year. If you found this valuable, hit that like button, subscribe, and ring the notification bell. I drop new finance strategies every week that most creators won't tell you about. Also, visit Own Your Finance blog for more in-depth financial tips and hacks, whether it's retirement strategies, tax optimization, investment planning, and more. Don't forget to download my free guide, Finally Break Free from Living Paycheck to Paycheck, the simple 10-step budget that actually works, and start building real wealth today. Both links are in the About section. Don't miss it. Thanks for watching and have a great day.